Wonder Commerce.
Hello everybody, today we'll be seeing a video on the basic accounting terms that we need to know before we get into the process of accounting. So let's get started off with accounting year. Accounting year is very simple to understand, like how we have January to December as a calendar year. Similarly, for the process of accounting, an year is defined by 1st April to 31st March. That is a period of 12 months for the process of accounting to be carried out. That is opening the accounts on 1st April and closing the accounts on 31st March to analyze the financial position of the business. Next is entity. Entity is simply a reality which has a defined individual existence. So for example, A company or XYZ Limited or AC supermarket, all these are different accounting entities or different business entities. Next is an asset. We know an asset is something that we own. So similarly, for a business enterprise, an asset is a resource with economic value. It can derive future benefit from this asset. So assets are classified into current assets and non-current assets. Current assets are simply the assets which can be realized or settled within 1 year, and non-current assets are simply the opposite. Let's see the main examples or the major headings that come under a current asset. So current investment is nothing but the investment that is made in this year and is realizable, or you will be able to liquidate it within this year. Liquidation is nothing but the ability to convert an asset, a current asset, into cash. Similarly, inventories are nothing but the goods that are stored, the goods in hand, which can be easily converted into cash. Next is the trade receivables. Trade receivables is the amount which is receivable by the enterprise within the current accounting period. Similarly, short-term loans and advances are nothing but the loans and advances that a company has given out to its employees, or if it is a financing institution, to the public, and it is recoverable by the company within the current accounting year. Next is cash and cash equivalents. Those are nothing but the cash in hand and cash at bank, etc. And then we have the other current assets. Next we come to non-current assets. Non-current assets are nothing but the assets which have a holding period of more than 1 year, 1 financial year or 1 accounting year. So under non-current assets we have fixed assets. Fixed assets, we can give examples of land, building, machinery. All these assets stand for a long period of time and also have a huge benefit for the future benefit for the business enterprise. Next we have the non-current investments. Like the current investments stand for the 1 accounting year or 1 financial year. Non-current investments stand for more than 1 accounting year or 1 financial year. Next is the deferred tax assets. Deferred tax assets is a very simple term that we can understand easily. So for example, if I own a business enterprise and my business enterprise has to pay tax of say 50,000 and it has paid tax of say 60,000, then this 10,000 which is in excess, which I have overpaid, is known as the deferred tax asset for me. Similarly, if I haven't paid 50,000 and I have just paid 40,000, this 10,000 now becomes a deferred tax liability for me. I owe 10,000 to the tax department. Next is long-term loans and advances. If the business enterprise has given a long-term loan or advances, it is recoverable for a period more than 1 year. Like after only 1 year or so, the amount is recoverable. That comes under non-current assets. Next is liabilities. Liabilities are nothing but any obligations which is to be met by the business enterprise, which is to be paid by the business enterprise, are known as liabilities. Now liabilities are also classified into current liabilities and non-current liabilities. So the next term is capital. Capital is the investment made by the owner into a business. For example, if I am about to start a restaurant or if I am about to start a stationery shop, say Wonder Commerce stationery shop, then in that I would have to invest an amount in order to commence the business. Say I have 10,000 rupees in my hand or 10,000 bucks in my hand, and I invest that amount into the business. That is known as the capital. I start the business or I commence the business with this capital. So this capital becomes an obligation for the business entity to pay back to the owner, because the business is a separate entity and the owner is a separate entity. Both have their own individual identities. So it is shown in the liabilities side of the balance sheet. Next is profit, gain, loss. So profit and gain are often confused with. Let's see what profit is. Profit is the excess of revenue over related expenses. So to make it simple, let me take an example of a manufacturing concern, and this manufacturing concern invests or spends some money in the purchase of raw materials and appointing some labor for manufacturing the goods, and the final product is manufactured. Now the amount that I get by selling these goods is known as my sales, that is the proceeds from these sales. If the proceeds from these sales, the revenue, is more than the expenses that I incurred for this particular manufacturing concern, then that excess amount is known as the profit. Now let's see what is gain. Gain is nothing but the profits that a business enterprise gets due to, which is incidental to the business. Incidental to the business means some things which are out of the operation, out of the normal operations of the business. For example, if I gain something by selling an obsolete or old machinery, if I gain something by selling off my fixed asset or anything, it's not a part of my business operation, but I got some profit out of it. This is calculated as the gain. Now next is the loss. Loss is the total opposite of a profit. When my expenses exceed my revenue, that amount which exceeds the revenue is known as loss. Debtors and creditors. It's very simple to understand this, but this is also a very important concept in the field of accounting. So right from the beginning to anywhere we have debtors and creditors. So debtors are shown in the asset side of the balance sheet. Let me take an example of a customer named Mr. X. So Mr. X comes to my shop and buys goods worth rupees 50,000, and at the time of payment he realizes he has only 30,000 rupees in his hand. So what I do is I say, you take all the goods and you pay me just 30,000 and take all the goods. The remaining 20,000 you can pay it to me later. I know this person very well, so I give off the goods to him for a credit. So this person, Mr. X, becomes a debtor to the business enterprise for an amount of rupees 20,000. That is, he owes the business enterprise rupees 20,000. So I record him as Mr. X under debtors in the asset side of the balance sheet, amounting to rupees 20,000. This is debtors. Creditors is the total opposite. Creditors is the case where the company owes to some other person. I have a liability to pay Mr. X rupees 20,000. That is creditors. So creditors comes under the liabilities side of the balance sheet. We have few other important terms that we need to know before we proceed. Purchases are nothing but the total goods that are procured by a business in order to, say, manufacture it or resell it. It depends on what type of business it is. Next is the goods. Goods are products which the business unit is dealing with. Now, we all know what generally discount means. Discount means a reduction in the actual price of the product. So under discount we have two types of discounts, which is the trade discount and cash discount. Trade discount is the type of discount that is offered by the seller to the buyer as a reduction in the price of the product. This is done to ensure bulk sales of the product, and it is not shown in any books of accounting. Reduction is adjusted with the final price and the discounted price is added to record books. And cash discount is nothing but the discount which is offered by the seller to the buyer on the invoice amount at the time of making payment within the stipulated time. So this is done to ensure prompt payment for the items purchased, and it is properly recorded in the books of both the buyer and seller. This cash discount is allowed at the time of the payment. Next we have voucher. Voucher is nothing but any documentary evidence that is made for a transaction. So for any transaction, a documentary evidence is made, and this is known as a voucher. Next we have drawings. Drawings is any sort of withdrawal made by the owner of the business in either cash or in the form of goods. Next we have stock. Stock is nothing but the on-hand goods, spares and other items that a business.
And do not forget to subscribe to our channel and stay updated.